Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry, 888-713-2929. And before we get going, I want to thank Daryl here. I looked at the show he put up on LinkedIn just about an hour and a half ago. Man, I'm looking good.
Oh, you're sharp. I got people telling me Mark Allen came in today and said, man, he's a pretty man. And the video matches his personality.
Oh, man, it was great. I think it was the yellow tie and the blue shirt. So I matched it today, but with stripes and a darker tie. I hope everything looks good for us.
GQ, baby, GQ.
Thank you. Okay, so again, I'm Jeff Barton. I'm your voice in the mortgage industry, 888-713-2929. Thanks, everybody, for listening in, and thank everybody for their patience through the time that we were in the fire and down. Last week, of course, we were on, as we are every week, but during the fire in the Malibu area, yes, I was out for at least a week, if not two. It was difficult. We're still not back in our house. Anybody who has experienced something like that with a flood or a hurricane or a fire or an earthquake knows exactly what I'm talking about. Disasters are exactly that, and I have a segment that I want to talk about a little later in the show about disasters and really how the disaster begins once the original disaster is over, and I'll explain that and how it works and the prey that you become when companies begin to look at you as a product rather than a victim, and those people who are into, I guess, preying on people. Heck, in the mortgage industry, it's all over the place. And I remember back in 2007 in Florida, there were a number of homes which were taken away from the elderly homeowner. And why was that? The reason that is simply the homeowners thought that they were doing a loan mod, and actually what happened is the homes were, in lieu of foreclosure, signed over to an investor. And one day a new tenant showed up, actually was the new owner, and said, hey, what are you doing in my house? And the older people, and there were a lot of them down in Florida, said, what do you mean? I've owned this house for 50 years. Well, not anymore. They presented their deed. They presented, their ownership. They got the sheriff. A lot of people were hurt. So in any circumstance, in any disaster, in what's happening, pay attention, because people will prey upon you because you are elderly, or you're a victim in a disaster, or you're just stupid. And people who are stupid, that's okay. I'm stupid in a lot of ways in terms of what I do with my business, with my family. You can't be omnipotent. Nobody knows everything about every situation, especially when it's segmented and the solutions are, you're not quite sure what they are. The insurance scams that are out there right now, the people that are trying to sell you on how to clean your home properly. Yeah, I'll get that to a little later in the show. I just wanted to alert you. Got a couple of great guests today. Wendy Van Wessel from Stearns Lending, and Mark Glasser, who has not been on the show before, from BAC. It's out of Florida. He was telling me earlier that he wants to try to get some of our West Coast loan officers to give him a call. I want to thank Malibu Funding for sponsoring the show each and every week. It's an expense for them, and we come on and we do whatever we do, and we really appreciate that. Just because, hey, look, you know what? Bringing information to people who need it about the mortgage industry is not the most glamorous thing, and we don't have the best sponsors or the most advertisers, but we do a public service. We bring information about rates, about programs, about different lenders, about experiences that you might have had trying to get your own loan in the marketplace. So let's talk about the marketplace a little bit. What's going on in the economy? I think what's going on in the economy is evidenced by the stock market up and down in the last 3-4 weeks, maybe 6 weeks. Whether it's a down 700, up 400, down 300, up 200, whatever has been going on is an indication that we are in that point of the market where you should be looking at protecting your job, protecting your home, making sure that there's enough income to pay the mortgage. We've seen this happen many, many times in California, whereby we get to a point in the economy. There's a couple things that went on last week. They are, I don't know if you know, Daryl, you know what this thing called the inversion curve is?
That one I've not heard of, but it sounds atmospheric to me.
And it's
probably not.
It's horrible. Well, it's kind of an atmosphere, but it's the financial atmosphere is what it is. So what happens is in mortgage interest rates, we look to the 10-year bond, okay? The government sells debt. Let's just really break it down. They say, I will pay you tomorrow if you give me money today, much like the hamburger guy. Wimpy, thank you very much. I'll pay you on Tuesday for a hamburger today. Right. Well, that's very similar to what the U.S. government does. And why do they sell debt? Because somebody has to pay for what the government's bills are today. I think we have a 13, 14, 15 trillion dollar debt? Well, there's debt service on that particular thing. And what is debt service? I'll sell a bond and I'll promise to give you more money than you paid me for the bond, but it's going to take me 5 years or 10 years. Let's say 10 years because that's what's affecting the mortgage interest rate. So that's debt service, they call it, and somebody's got to pay that. So that's what this is all about. So what's happening in this inversion curve? Okay, so the longer out the bonds are, the more money you're supposed to get. Like a 3-year Treasury note is supposed to pay less than a 10-year Treasury note. And that has been happening quite often during the last, let's say since 2007, so 11 years. Well, recently, and not for the first time, but a couple times recently, and that would be in months, we have seen the inversion of that curve, meaning that the short-term note or the 3-year Treasury bills is paying more than the long-term note. And that's what we call an inversion curve. When that happens, that portends or it reflects or it's a precursor or, look, it's predicting a recession. That's what it does. And not necessarily tomorrow, but it's an indicator of within the next 18 months, we're going to see a recession. And is that 100%? No. What's 100%? Donald Trump's an idiot? Yeah, that's 100%. And I'm sorry, I got political there. But the reality of it is that the inversion curve is not a good sign for people out there who are in the economy, who are looking for either the economy to keep roaring along. Now, this year, in 2018, we had a pretty strong year, and we're probably going to have 3.5 to 4% growth, gross domestic product growth rate. One of the people in the economy that I admire, an economist, has said that the reason that is because we had that terrific tax cut this year, and that's true. And Reagan used to call it supply-side economics, where the government would borrow money and basically pour it in. The Democratic solution is obviously to spend money on social programs. The Republican strategy is to give tax cuts. Both affect the debt, and both are borrowing from the future to really enhance life the way we have it today. I don't know what the solution is, but I can tell you honestly that if you're out there and you're looking for a house and you're looking for the best in terms of your mortgage interest rate, best thing to do right now is to wait and see for at least another 90 days. Now, why do I say that? And it's bad for me because I'm in the business. Because I just don't know where the economy is heading. If we're going to slump into a recession because the Democrats are taking over the House and government grinds to a halt and we're going to get this back and forth, that's why it's very important and very interesting to see what's going to happen politically to both. Are they going to go after Trump for his impeachable offenses? Are they going to leave him alone? Are they going to try to build for the future and try to do things together to improve the economy? One thing I know is that it's unstable right now. The inversion curve proves it. And if we're looking at long-term debt, the actual debt that we are incurring here in the U.S. is growing by leaps and bounds. Not a good thing because it takes away from the money that could be spent on other things. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to the Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry. 888-713-2929. Pick up the phone, give us a call, write down the phone number, ask questions, email me if you want, info@malibufunding.net. We can be seen on YouTube. I've got a Twitter handle @Jeff6493. My blog is bartonblog.net. A lot of ways that I try to get information out to you, whether it's on a personal front or on a professional front. Everything we do here is to try to push what we're doing, which is to help you figure out, what are you going to do with your mortgage? I mean, the rates are what they are. They're growing. They're getting more expensive. I spent a little bit of time in the first segment talking about why, some of the underlying reasons why I'm a little bit nervous about what's going on in the economy. But let's talk a little bit more economics in terms of what exactly the fundamentals are. Okay, we hear this all the time. ABC might be happening, but the fundamentals are strong. And what are the fundamentals? Well, what the economy looks like to an economist and how we see growth in the U.S. heading forward. There's a lot of things that are interrelated, whether it be here, whether it be overseas, events that happen around the world. And by the way, Daryl, have you been watching what's going on in France? What's going on with the yellow vest people?
It's crazy.
It's absolutely insane. And this is because they raised the gas tax, right?
Yep.
Did they do that in California? Put the yellow vests on and riot?
Nope.
Nope, not at all. As a matter of fact,
we got it back on the ballot this last.
That was it,
yeah.
and it got voted. Yeah, we like the gas tax. Can you imagine?
But now they're going directly after the crazy train.
What? Well, you know
They
why?
don't want the extra taxes to go toward the crazy train.
That's another thing here in California. Everybody knows about the train to nowhere. I think it's between Barstow and Bakersfield or something like that.
Well,
or,
ultimately, it's supposed to go from Southern California to San Francisco.
Oh, it's supposed to.
Right.
Right.
But one leg of the train has exceeded the entire budget of the project.
It's just, it's crazy.
Billions and billions of dollars. Carl Sagan could predict how much it was going to cost.
So you're out there and you're thinking, okay, the fundamentals in the economy, I'll vote for taxes because it's okay. What the heck? I'm doing well. My job's great. My kids got jobs. My grandkids, I can help them with a house. Things are chugging along really well. So the fundamentals are, yes, you've got your housing data. You've got your manufacturing data. You've got your banking data. You've got your services sector data. We're in the season that everybody actually goes out and goes to the store, although online sales this year are going to exceed in-store sales by some phenomenal number. I think it's more like 70-30. 70% of the people buy their Christmas shopping online, where 30% go to the stores. But these fundamentals. They talk about non-farm payroll reports that you see. And if you're out there and you can remember pre-economic channels being like stars on TV, this was before the internet bubble back in 2000, 2001, 1999, in that range. But this economic plethora of data that comes out each and every day, not to mention weekly, monthly, and quarterly, portend things about what's going to happen based on what has happened. All the economic indicators are hindsight indicators, meaning we look at what happened and try to predict the future. So in the first segment, I was talking about the future as if I was looking at a different crystal ball than what they call the fundamentals. And the fundamentals really are pretty strong. Most people ever have been working in the United States. I think it's 154 million people have jobs in the United States, more than has ever had a job. Of the 250 million people, I guess 100 million people count old people and children, and everybody else is working. I think the unemployment rate is like 3.7%, something like that. So the underlying fundamentals are pretty good. Predictions of the future from now to 18 months, if we're looking at rates, and let's talk rates here for a second. What are they today? I'll tell you. 30-year fixed rate, 4.875%. Now, that's still under 5%. We're predicting one more rate hike this year, which will probably lift those particular mortgage rates above. I know that the president president has tweeted out many times that his opinion of Powell and how they're raising rates is really slowing down the economy, which is true. Hey, if you're going to get money for free, you're probably going to spend it, i.e. the tax cut. That was money for free. Cheap money, that's money for free too. If it's going to cost you an extra quarter point to a half a point, well, that may be nothing on a $100,000 loan, but on $1 million or $1 billion or $1 trillion loan, yeah, that's a lot of money. So FHA VA loans, 4.375 to 4.5%. Those are still pretty awesome rates when you consider. But if you add in the PMI on that FHA, it probably exceeds the 4.875. As you know, you have to pay an upfront mortgage insurance premium, as well as your monthly is a little bit higher because of that insurance. The 15-year fixed is 4.375, and the 5-year ARM is 4.375 to 4.875. Those ARM products are pretty good if you're looking for short-term solutions. What's a short-term solution? Hey, I move every 3 years because my job demands it. I'm in the military. I might be moving, in the next 2 years. These are short-term strategies which are obviously cheaper for you. You could probably use that time to build up equity in your home. Although this year equity has slowed, we're probably going to see under 5% growth nationally in terms of equity year over year, which is still good, but it's not the 6.5% it was last year, or in certain markets like Las Vegas, where it went up 16% last year. We're probably looking at much less this year. So if you're out there and you're looking for mortgage solutions, and who isn't? Although I did see that the real estate market has slowed considerably in San Bernardino and Riverside counties. If you're out there and you're thinking about buying a house, it's really a good time, because you're going to find the sellers right now more apt to want to negotiate because they want to sell that house before the end of the year. I know it's December, and you need to think about other things. You've got holidays, you've got kids, you want to be settled. But there are opportunities in the market. And before that rate hike, which I think is going to come in December 15th when the Federal Open Market Committee meeting meets. And again, of course, we all know that it has nothing to do with the mortgage interest rates. It's about short-term interest rates for banks and credit cards and car loans and the like, payday lending. But they tend to follow each other pretty closely, and as it affects bonds, and by the way, the bond yields have really gone up a little bit because, actually gone down, that's what I'm trying to say, because there's a flight from the stock market. If the stock market's volatility is such that it goes up and down, you're probably going to see the stock market fall more because, all these portfolio managers want to lock in their particular portfolio gains if they have any, so they put it into bonds this time of year, so you might see the bond yield fall a little bit more. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry, 888-713-2929. That's the telephone number here. If you want, write down the phone number. Get questions about things you hear on the show. We're not experts in anything, but we do know a lot about a lot of things in the mortgage industry, whether it's real estate related, whether it's fees related, whether it's rates, certainly, and lenders and options that you can have when you're looking around for a loan. You need to work with good people. You need to work with people you trust. But we treat you with respect here at Malibu, and if I can't do it, I certainly will find somebody that can. I want to thank Malibu Funding for sponsoring the show. Our 3 radio stations that carry the show, K-Tahoe, KCAA, and KMET in the Inland Empire, Riverside, San Bernardino. Say hi to all my friends out there. Okay, so we've had a lot of things going on in the lending industry, and I guess what I wanted to ask Wendy, and again, I have Wendy Stearns with me. I've told you that on an earlier segment from Stearns Lending. Wendy, first of all, how are you?
I am fine. Thank you very much for asking. I hope yourself as well.
I am, and I asked Wendy on because she too lives in Malibu, California, went through a disaster just recently. First of all, how are you, and how did you fare through that particular fire?
Our home still stands, but
Good.
That we were lucky because it was windy, and there's about 60 homes on Point Dume that are burnt to the ground.
Yeah, I know a lot of them right around me, and one of the things that, first of all, I'm glad your home's well. I'm glad you're well, your husband is well, and all the houses around Point Doom, whether it be here or in a number of other areas in California or any disaster area that deals with a disaster. How do you as a lender, or how does Stearns as a lender, how do they deal with disasters in general? And then specifically, if someone's in the disaster zone and they have a loan pending, what happens?
Well, let's start with the last question. Those people that have loans pending and their home is still standing, there are things called a Trinity report that the people have to go out and make sure that the house is still standing, and we order that and we pay for that.
Okay.
Or if it's a conforming loan amount, we can have the account executive go out and say that it's still standing. Or sometimes now, if we look at the map, because the maps are out now,
right?
They look at the map and make sure that it's not close to the burnt area, and they will okay it that way, the underwriting manager. So there's different ways of making sure the home is still standing, that you don't do a loan on a home that regrettably was burnt to the ground or burnt.
Right, and for somebody who's in a purchase and they're nervous, obviously there's all kinds of, in California there's a FAIR plan. In certain other parts of the country, whether it's on the East Coast that deals with hurricanes or flooding in the Midwest or a number of other disasters that can occur or quite normally now occur all the time, how do you handle in terms of those situations for those particular borrowers when they're in an escrow? How do you calm them down? Is there insurance that you try to talk to them about, or do you just, I guess I'm just asking because I'm grasping at straws. I don't know how you do it.
If you're in escrow
Mm-hmm.
and you're worried about the area, if it might become dangerous with fire and or now mudslides we have to watch out for here in Malibu because of all the burnt hillsides,
Right.
I think that I would look at a flood map. I would go look up the history of whether or not it comes down that particular canyon and goes through and burns, and see how long ago it wants to burn. I think it was 1993, and then there was one in 2000 out here. That when you're out in the area where there's a lot of brush around with the beautiful Santa Monica Mountains, sometimes you have fuel for a fire with those Santa Ana winds. That's part of what you have to watch out for, just like hurricanes in other places or earthquakes sometimes we get here. You prepare yourself, and then part of preparing is making sure that you have, generators, food, gas to run the generators, or propane, those types of things in case something happens. We didn't have internet until Sunday the 25th, I think, and it started on the 8th. So that was a long time without the internet and not being able to do business, especially if you do business out of your home.
Right.
There was no electricity. There goes everything in your freezer. There goes your hot water showers. It's very different, and it was like an island out here for a while with the boats coming in and the surfboard the supplies to the shore. It was very unusual. So do your research. Do your due diligence as to where you're buying your property to make yourself feel safer. Don't be a worrywart, but also don't be blind when you're going into where you want to pick your property to live.
And does the rate get affected by the fact that you may be in an area that actually has, a little more danger in it? I mean, if you're in California, I guess this is redundant, but we all live in the earthquake zone, right? I mean, all of us. But if you're closer to an earthquake zone, or if you have to get the California fire plan because you're in more of a fire zone than somebody else, do rates get affected accordingly?
No. Insurance does.
Okay. Oh, your insurance. I see.
Would absorb that part. There is a good program, though, for the FHA 203H.
Tell us about that.
That is a program, like a lot of these people here, they don't want to stay in a motel while they're rebuilding their homes, but they could get maybe something in the valley. For now, our high balance limit is $726,525. Get something that's 100% financed, and they help you with the closing costs. They look at your payment on the other burnt-down home, and they don't discount or they don't penalize you for not making that payment where the home doesn't exist anymore. They also kind of roll in some of the cost of repairs if your house wasn't burnt to the ground. It's called 203H, and I'm just debating with our company whether or not we do it to the high balance or just the conforming, and I'm still working on that answer. I think we do it to the high balance as well, but it's a great program for people that want to put their family somewhere and settle them while they're rebuilding.
How does that work? Tell me about it, because I'm not quite familiar.
Well, it offers up to 100% on a purchase of a home.
Okay.
The new property doesn't have to be in the same area as the home that was destroyed.
Mm-hmm.
The program refinances an existing mortgage and rolls in the cost of repairs into the new loan. The restructuring financing is available regardless of the age of the property. The flexible guidelines Also on financial hardship because of the disaster, alternatives to documenting income and assets if the family's paperwork was destroyed. Credit scores of 580 and above are acceptable. So they're trying to work with these families on this FHA program to get them back into a home, to give them 100% financing, to, like I said, not penalize them if they're not making the payment on the home that they can't live in anymore.
Right.
And their documents.
How does that work, Wendy? When someone has their house destroyed, but they still have a mortgage payment, and they don't have insurance, how is it supposed to work when there is no asset with which to, I guess, collateralize the loan?
They're still working, are they not?
Well, no. I'm not saying they shouldn't pay or that they can't pay. I'm just saying, what is their incentive to pay?
Oh, no. That's why if they have because they don't want to lose their property. They want to rebuild, right? That they want to. Their insurance might cover some of it. It might take a little while longer.
Right.
But you don't want to have your families living in something, living where they can't. They want to have another home, and they don't want it to be necessarily a hotel. They don't want it. They want to have another temporary home while they're rebuilding.
Well, I've been telling people the same thing. I'm saying, hey, look, you know what? If you have a disaster and something happens, you still have a mortgage outstanding. Mm-hmm. You got to figure out a way prior to, if you're in any of these disaster areas, what's going to happen if? And part of that is the solution for how do you pay your mortgage? Do you keep working? Do you keep paying? I mean, you got another place you got to live. How does your insurance? So all of these things have to work together hand in hand with your planning, along with, you got to have a flashlight and food and all this other stuff. But certainly that's a big, big problem with a lot of people who didn't plan for the fact that, what if my house, if something happens, it's a hurricane, it's a tornado, it's any kind of fire, certainly, earthquake. What happens if?
What did we say? We said it never burned. People from Lake Sherwood came to the beach because they said it never burned to the ocean.
Right.
and then we have the natural fire break on PCH. So, no, it never burns. And it wasn't even that windy on Friday night. It was very scary when I left at 6 o'clock. But
right. I left at about 2:30 that day. I remember it well.
Stuck in the traffic then. That evacuation was tough. So you asked about qualifying, right? And it says, when a borrower is purchasing a new home and the payment on the destroyed residence is located in the PDMDA, may be excluded from the borrower's liabilities. To exclude the mortgage payments from the liabilities, the underwriter must obtain information. Here we go again. Sorry about that.
No problem at all. I mean, you're quoting obviously chapter and verse from your lending guidelines.
Well, I think it's FHA.
Oh, I see.
Obtain information that the borrower is working with the loan servicer to appropriately address the mortgage and obligation. Apply any mortgage insurance proceeds to the mortgage of the damaged house. So you just have to prove that this was a home and you can no longer live there, and you can exclude that payment.
Well, this is another good thing about FHA loans. Even though you're paying the mortgage insurance premiums, you are insured.
Yeah.
And, for those of you that have 20% down and your house is burned, you might get a rebuild cost, and you have to rebuild if, in fact, you want to recoup anything from the disaster. Because if you do sell and you do, get insurance money on the rebuild, it may not cover the mortgage that's currently on the property.
Right, and they also don't have to go into their family's home or their in-laws' home or the hotel.
Right.
They can get and purchase a new home and not have that debt hit their debt-to-income ratio.
Right, exactly. Wendy, I thank you very much for coming on the show once again, just educating us as to what the disaster means at Stearns and also the FHA update. That's good information.
Thank you very much. Be smart and be safe.
Thank you, Wendy, and thank you very much. That's Wendy Van Wessel from Stearns Lending. I'm Jeff Barton. I'm your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry. 888-713-2929. That's the telephone number. Pick up the phone. You give us a call. Write down the questions. Give us a call. Think of something you want to ask and give us a call. You certainly can email us, info@malibufunding.net. If you go to YouTube, it's Jeff Barton, the real estate voice, and you can see hundreds of these shows that we've had archived there. Also, the Las Vegas Real Estate Show, which has been there for at least a couple of years. A lot of good information on all of these platforms to be able to get in touch with us and for us to be able to reach you. I'm certainly on Facebook. I'm certainly on Twitter. and a number of other things. As I said, I've got a blog, and yeah, all these things are designed to really communicate whatever it is that's going on in the mortgage industry out there to the general public and to you specifically. I have contact with a number of great loan agents at Malibu Funding, and if they can't help you, I certainly can get you in touch with somebody who can. We have been in business a long time. I've been in business for over 20 years, so I know a ton of people who can help. A lot of contraction in the mortgage industry going on this year and next year, and what do I mean by that is choice will become more limited, not expanded. As what happens in every business is when supply diminishes, you're going to have more companies go out of business or get swallowed up or get bought by larger entities. The reason for that is that larger entities need volume in order to stay open. They need to grind out production in order to satisfy the underwriter's salary, the manager's salary, all of the people who are invested in that particular infrastructure. They need a certain amount of loans every day. I was looking at an article that said your average, not average, what did it say? It said, I think it was your average lender did about 1,800 to 2,000 loans a quarter. So that's about 6,000 loans a year, right? 18,000, 8 to 10,000 loans a year. Okay, so that's your average lender. Well, most of the brokers who are in Southern California who are servicing San Bernardino and Riverside probably do no more than 100 to 200 loans a quarter. Right? Maybe even less than that, maybe 50 to 100 loans a quarter. And that's a pretty good business if you are an owner-operator, meaning I'm the owner, I'm originating all the files, I have my processor, I'm submitting them to the lenders, and they're funding the loans. Because there's only a certain amount of people that you can touch, and we've all seen those ads on Facebook, or they get emailed to us about the amazing person who's doing 10,000 loans a year or 100,000, real estate transactions a year, and they're going to sell you their system so that you can go out there and do the same thing. Well, as someone who's been in the business a long time, it's very difficult to be able to predict how well somebody's going to do versus somebody else. And for somebody that thinks they can do 400, 500, 600 loans a year or 400, 500, 600 real estate deals a year, that's not happening. Not unless you've got a very well-oiled, very experienced team whereby you're doing 10% of the work and they're doing 90%, i.e., I'm the face, I go out there, I meet you, we meet for 10 minutes, and I just pass you off to somebody else. Because the business itself demands, and certainly those of us who are in Southern California who are in the small mortgage lending, which, by the way, mortgage lenders, mortgage brokers have become a larger and larger component of major banks around the country and major lenders because the origination requires time, effort. And if you do it through a bank or you do it through a major lender, it costs a lot of money. The bifurcation of the origination process, i.e., the broker does the origination, the underwriting and the processing get done by the lender. That's how lenders are growing. And in this consolidation market where we've got more and more people demanding of less and less loans, it's very important to understand as a consumer, if you go to a mortgage broker, you're more apt to be able to get a better deal. Now, why do I say that? Because they're able to shop around. They're not hemmed in by the amount of money that they're borrowing from their investor, the margin that they've got to place into each deal, and the amount of people they have on salary. Most mortgage brokers, as I said, are owner originators, meaning that it's just them and their processor and whatever their overhead is at the office. So they're able to shop around for the best rates. I know my own particular company that I work for, Malibu, they probably have 35, 40 different lenders on the mortgage broker side. Now, granted, they're also a correspondent lender, so they're able to do some different things depending on the borrower's situation. But choice is really important when you're out there in this rising interest rate market. So let's talk about 2019 a bit. And let's talk about buying a house. What are some of the things that you're going to need to buy a house? Darryl, what do you think the number one issue, according to this article written by Jeff Antilia on December 4th on the home buying process in 2019, what's the number one consideration?
Good credit.
Good credit is number one. You are absolutely. You know what? Did you peek over my shoulder?
I did not.
Well, that's very.
I've got mirrors on my shoes.
Oh, it's excellent. Okay, and this article says before applying for a loan, and certainly before ever making an offer on a house, you should know your credit score. Couple of free credit scores, freecreditreport.com. I know that Experian, Equifax, and TransUnion all give you free credit scores. All you have to do is log into their websites. You are owed one freebie a year. And so maintaining that, go ahead, Daryl.
Yeah, Credit Karma also is.
Credit Karma is another one.
It's free. You have to look at a couple of commercials, and you may get some advertisement like credit card stuff afterward for
Right.
risky folks, but yeah, it's a good place to look.
Okay, very good. Number 2 on the list, what do you think number 2 might be?
Down payment.
Know what you can afford. That's exactly right. Down payment is exactly that. If you've got 20% down on a $200,000 house, but you want to buy a $400,000 house, now you got 10% down, you might not get the credit, the interest rate that you want. Higher the down payment, lower the interest rate. Higher the credit score, lower the interest rate. Now, if you're going FHA, you're only going to pay 3.5% down. Now, there are some down payment assistance programs out there. Check with your lender, and certainly with either the city or the county in San Bernardino and Riverside. Both of them have down payment assistance programs. But if your FHA loan, because you're so little down, 3.5%, the rates are actually better than your 30-year conforming, but you do have your mortgage insurance premium to pay. Your upfront fee, I believe, is, let's say it's a point. So if you've got a $300,000 loan, you got to pay $3,000 up front, plus I believe it's 0.55% on a yearly basis of the $300,000. So if it's $3,000 divided by 12, divided in half, that's your extra monthly payment that you're going to have to make on that particular loan. What's number 4? What do you have up? Go ahead.
Oh, those are the top 2 as far as I'm concerned.
Get another one. Go ahead. Throw another one in there.
Some idea of what you're looking for.
Yeah, that's true.
Yeah.
And I would say that according to this article, they're talking financing here, and they talk about what is your best option for being able to get what you want. And it's certainly knowing your finances, having a healthy debt-to-income ratio,
right.
Building up your savings so you have a great down payment. All these things
It's kind of the same thing.
Yeah, it is kind of the same thing. Know what you can afford is really, really the most important thing, because if you don't, you're just wasting people's time. You're wasting your time. You're wasting the seller's agent's time. So what are you going to do for the holidays, Daryl? Let me ask you that.
We're probably going to be around. My sister-in-law's in Austin. We may visit her for a couple of days, but for the most part, we're live in paradise. We're going to be here.
Absolutely. Okay. The reason I bring that up is it is December. Holidays delay people from decisions they might want to make today. It's a great time in December to be able to go into the marketplace and take your time, look for some opportunity. Most buyers, let's take the month off. Most sellers pull their properties off the market. But those properties that are left, there's a reason they're left on the market. Those people have to sell. And we're now in a much different environment than we were 6-8 months ago. More even number of buyers to sellers, more incentive as rates go up because there are fewer buyers, and sellers are more willing to negotiate with you. So keep that in mind during the holiday. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry, 888-713-2929. That's a telephone number. Pick up the phone. Give us a call. Write down the number. Save your question. Call later. We are available, and we are here to help you try to figure out what you want to do with your purchase or your sale of your property. What you're going to do with that money. Do you want an investment property? Or you're looking for some kind of income, you're retired, and maybe you want to buy a rental property. There's all kinds of questions that you're going to need, certainly in this rate hike environment that we're seeing right now. We're probably going to see another one in another week and 10 days. There's a lot going on in the mortgage market. We've talked a lot about disasters in the past 3 weeks on the show, and I brought a guy who hasn't been on the show ever before from A&D Mortgage, the wholesale team manager, Mark Glazer. Mark, how are you?
Good evening.
How are you? How's it going?
Oh, real good down here out in South Florida.
Okay, so being that you're down in the East Coast in Florida, what's the weather like down there right now? How's it? Is it beautiful? You at the beach right now?
We're sunny and 80 degrees.
Oh, man, that sounds awesome. Out here in Southern California, we're recovering from our recent fire. We have a bunch of them. I know on the East Coast, you guys deal with all kinds of weather-related issues, hurricanes, rising tides. Tell me a little bit about A&D, what they do in disaster-related situations, and how you guys are handling properties that may be in those particular areas.
Well, being here in South Florida, we encounter hurricane season. Pretty much last year when we had Irma, during the about a month of recovery time, what we end up doing, number one, in the case of purchases, the homes have to be re-inspected.
Right.
That's really big. So even if you had an appraisal,
right,
and you were ready scheduled for closing, you have to go out and have re-inspectors to make sure that the properties are still structurally sound after an event. Hurricane for us,
right.
Fire for you.
Right. Okay, so basically this is a standard industry practice that is used on both coasts. Send people out, look at the property, make sure it's still sound, make sure it's still there, and the availability of funds for A&D are as good as gold at that point, right?
Yeah, once you have the property re-inspected, if one had an approval and the property is good to go by the appraiser, you already were set up for closing, then you would proceed.
Right.
Also, we encounter situations whereby, and you have them too out in California, when there are storms coming and you're in the cone for insurance.
Yep.
So it's always good that when you are during the hurricane seasons or during the storm seasons, that if you're getting set up to go to closing, to try to buy your insurance early, get it in. If for some reason you don't close, of course, you get your money back if you don't close on the insurance. But to have it available so that if a storm does come off the West Coast, which you've had a few this year, you won't go in the cone, and then you may not be able to close because you don't have insurance.
That's a great idea, and we had a gal on from Stearns, and I asked her the same question. Your answer I like a lot. The fact is that to make sure that you can get the insurance, buy it early, so that if you're in that, like you say, that cone of the storms happening at that particular time, it's just a great idea, and I had not heard that, but I appreciate that, and I'm sure the listeners do too.
Right, because when you're in the cone, they no longer insure.
Right.
They won't bind is the term, and you can't close.
Okay, let's shift a little bit. Some of the programs you guys are doing now there in Florida that might translate out here into Southern California.
Well, A&D Mortgage lends nationwide. We do lend in California as well. Good. As Florida, New Jersey, several of the states, but we'll discuss California per se. We are focusing these days into the non-QM, the non-qualified mortgages, whereby an individual can get into a loan with perhaps just a profit and loss from a CPA. They could get into a loan in the case of investment, even they have a no-doc program, a no-income, just using the DTI, a no DTI loan whereby you use the debt service of the property. we have several interesting loans available, 12-month bank statement loans, 24-month bank statement loans. We could even do a loan with one tax return. If you're looking into specifically for investment, we could do asset depletion where they determine income from the assets that you have, and that could be actually a source of income.
So let me ask you a question. How much money do you need into the property? Is it like, or 10, 20, 30%? How much are you looking for the borrower to bring to the table?
Generally, let's talk about in the investment arena, you're usually looking around 20 to 25% down in the investment area. When you look into the owner-occupied, meaning the primary and second homes, you could put as little as 10% down and still be able to do, some of the lighter dock situations. Let's say, for instance, you want to do a 12-month bank statement. You could put 20% down at 80% loan to value. You could do 90% loans on the full dock with no mortgage insurance. We have that available.
Oh, that's good. 90% down, no MI? That's pretty good.
Yep. So you could put 10% down, get a 90% loan, and have no MI. We also offer 5-1 ARMs, 7-1 ARMs, and 30-year fixed loans.
What are the typical rates on this non-QM product that you're offering? I know that some of the non-QM around, and a lot of people are into this space now, are very close to what is currently conventional and, maybe a point off. How are you guys dealing with that? What does your rate sheet look like?
So when you move out of the standard Fannie Mae, which is your 30-year fixed, 10% down type of loan primary, or a loan of that sort, and you move into this space, the interest rates are all dependent on your credit scores. So if you have a higher credit score, let's say in the mid to high 700s, you could find your rate in the 5s to low 6s.
Mm-hmm. That's good.
If you find your credit scores into the mid 600s, you could find your rates in the 6s and low 7s. And generally, again, what these are for is when you do a 12-month or 24-month bank statement loan, when you do a loan with just a profit and loss from a CPA,
right,
or you're doing a loan such as that, or if you're moving into the investment area and you're trying to do, let's say, what they call as a debt service loan, where we rely on the property as opposed to the income from the borrower. When you're in that realm, you're looking at rates in the 6s to 7% range.
That's amazing. You know what? That is such a good... If you're looking at just the income on the property to satisfy the debt, and your rate is only 6 to 7%, that's tremendous. That's a tremendous product.
Right. So it'll all be depending on credit score. Your 6s, of course, are in the high 7s, in the mid to high 7s.
Right.
And your 7% rates will fall in the mid 6s.
Okay, so I have about a minute left. If you were, a young couple, you're looking to get a house, and, you've got one of these credit-challenged, issues with your own borrowing power, what's the best loan that you could think of? They're earning good money and they can pay for the loan, but what do you think in terms of credit challenges to be able to help out a young couple like that trying to buy a house, a millennial, let's say?
Well, I just came across a situation whereby we were able to do somebody with a mid 6 credit score, the mid 650s.
Right.
They were able to have a 85% loan to value. They had a foreclosure about 3 years ago.
Right.
And literally they were paying on a tax lien, but they had the document that showed that they were making payments on it. I was able to get a 7.5% 5-1 ARM to do the loan. So it was available as long as you document.
Wow.
85% loan to value. So it was a mid 7s.
That's a great solution for that kind of borrower. That's tremendous, really.
So we have all of that, and I'll leave you also with something that was pretty interesting we found. when you're doing a primary or second home, again, California is a pretty good area for this. We're able to do at A&D Mortgage a 10% down program where your credit score is right there, in the high sixes into the sevens.
Right.
90% loan to value, up to about $1.4 million. No MI, and your debt ratio, meaning your bills to your income, we were able to go up to a 55 DTI.
Wow.
With 10% down, up to $1.49 million.
Wow. You know what? If you're out there right now and you're listening to this particular pitch on great loans, you got to give Mark a call. Mark, shout out your phone number quickly, will you?
Yeah, we're at 954-309-2960.
Thank you very much. I appreciate you coming on the show, educating us, and showing your wares to our audience. Thanks very much.
A pleasure. You have a good day, sir.
You too, Mark. Thank you very much. And that's Mark Glazer from A&D Mortgage. I'm Jeff Barton, your voice in the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.